The Financial Action Task Force, a global anti-money laundering watchdog, has a set of recommendations for crypto firms. Among them include guidance for unhosted wallets and the travel rule, which refers to how transaction information should be shared among crypto firms. Joining us now is Rick McDonell, Executive Director of the Association of Certified Anti-Money Laundering Specialists and former Executive Secretary of FATF. Hello there, Rick. Thanks for joining us. So maybe you can walk us through some of the key points in the new guidance released by FATF.
Well, first, thank you very much, and good morning, Christine and Lawrence and Emily. My pleasure to be here. The guidance, I would say, first of all, going back to what your previous guest said, the area of crypto now is too big to ignore, and that's the same on the regulatory side and growing very fast. So that means that all of the rules that traditional financial institutions have had to abide by in terms of anti-money laundering compliance for many years also now apply to this sector, to both stablecoins and to VASPs, virtual asset service providers, and to cryptocurrency in general. So it's all about identifying who your originator of the transfers of money are and who is the beneficiary of that. Now, that might seem to be easy and not rocket science, which frankly it isn't, but the crypto platforms on blockchain were not established or not engineered to do that, as opposed to the traditional financial institutions, which have for many, many years had a compliance requirement to identify their customers, to ensure that there's customer due diligence, meaning what are they doing, monitoring their accounts if there's any suspicious activity, and reporting those to the right authority. In the US, it's FinCEN. And those rules are the ones which the guidance that's been issued recently indicate that the industry has to now apply. But it isn't easy. There is no solution at the moment that I am aware of that's immediately available for identifying the counterparties, but they're getting close, I believe.
So what's on the horizon for crypto service providers? How will they be impacted? Do you see them as collaborating and being, accepting this guidance and incorporating it in their practices?
Well, that's a good question. I think there was some reluctance, to put it mildly, at the beginning as to whether or not these rules should apply to a space which is essentially decentralized and not burdensome in terms of bureaucratic requirements. But the fact is, they have no choice. And I think they've come to terms with that the compliance requirements are facing them the same way as they are facing banks. And they've come to terms with that, in my view, and are now trying to build what I might colloquially call a dating app solution. In other words, how do you ensure that the identification of the person you're dealing with and the identification of the recipient of the transfer are real? And secondly, can you be sure that the VASP that you are a counterparty with, in other words, that you're exchanging money or funds with, is also reliable in terms of its capacity to identify risk? So we've got basically two things in operation here in relation to your question. One is, do they have to apply the same rules? The answer is categorically yes. Two is, how long will they be given to do that? The new guidance says it will be a phased approach. It doesn't give a timetable, but it recognizes that the re-engineering of the systems to identify counterparties in a decentralized system will take some time. But I think one thing to bear in mind, especially in the United States, recently there have been many issued reports and statements from the Secretary of the Treasury to the President's Working Group on Stablecoins and to the SEC and others, which sound some alarm bells in relation to risk in general, not just money laundering, but also consumer protection and prudential issues in terms of potential fraud, etc. So as this industry and the volumes of transfers are continuing to skyrocket, then that still also applies to the money laundering requirements.
So Rick, I do want to ask you about the President's Working Group on stablecoins, because after reading it, do you consider, what's the general sense? Is that stablecoins may be even more of a threat potentially than privacy coins in terms of money laundering? Is there a consensus among regulators as to whether or not that's the case?
Personally, I don't think there is yet a consensus, and I think that's because when one looks at risk, and the underpinning requirement in all of this is, do you know who you're dealing with, and do you know the risks associated with not just those people, but with the products that you're using? And the products are a variety of things. So in relation to your question, I don't think it's an apples to apples consideration. It's a matter of what the risks are in relation to your particular product. So for stablecoins, I don't see that as any particularly more difficult risk associated for money laundering purposes. It all comes down to, can you identify whether or not there's something unusual or suspicious going on once you've got the capacity to identify people who are doing the transactions. Most people doing these transactions are quite legitimate. The transactions are legitimate. The issue really for anti-money laundering is what is illegitimate. And I think in that sense, the rule applies across the board equally. So the important
there's recently
thing is,
been quite a... sorry. Go on.
No, go ahead.
Go on.
I was
just
going
to ask you a slightly different question, which is there has recently been a huge boom in the NFT market, and I'm curious, how much NFTs are on your radar as a possible means for money laundering.
I think NFTs have become very newsworthy in the last 6 to 12 months, but they're not the main focal point at the moment, because the volume and value of transactions, as far as I can determine, is nowhere near the actual pure transfers of value or money on the crypto space, whether that be in the US, convertible virtual currencies, stablecoins, and any other cryptocurrency transaction has a greater volume attached to it. So I think that NFTs should be on the radar and are on the radar, but they're not the main game at the moment, in my view.
You mentioned that crypto service providers may be reluctant to abide by FATF guidance. So I'm wondering how FATF might, or global regulators might get them to agree, because when global crypto policy takes shape, how do you see that going forward, considering that, various countries have different approaches to crypto? In China, at least, they are having an outright ban and crackdown. In the United States, a little bit more interested in exploring it. And in other jurisdictions like Panama, Bahamas, they're much more liberal in their policy toward crypto.
Yes, well, it is a mixed bag indeed, as you say. But the fact remains that while I said that there was reluctance because the systems were not built this way, there's now, I think, an acceptance that if you don't put in place a compliance framework that's robust and you can't identify who the beneficiary and the originator of the transfer is, then the regulators will come down on you very hard. And I think that's been noted recently. Again, the Secretary of the Treasury and the President's Working Group has indicated that that in that report that there's legislative change that's also necessary in the US. And until that time, if Congress agrees to make changes to the legislation to make things more stringent in this space, then they're encouraged, all the regulators are encouraged by that report to ensure that they use to the maximum the mandates and the sanctions that they have available to them now. So I think it's going to get tougher. It will be phased, but I think you'll see an increasing number of sanctions being applied within the existing laws if the compliance frameworks are not acceptable to the regulator.